Good evening, friends. Good evening, friends. On behalf of the Women and Young Members Excellence Committee, it is my proud privilege. Am I audible? Today is the 74th session of the Sky High Symposium series, and it was started in April last year. And this platform has been created specifically to share technical updates so that we can equip our members, as well as to help them gain non-technical skills so that they can make the most of the opportunities that are available to them and also put their best foot forward by speaking extremely confidently at any public forum. The chairperson of the Women and Young Members Excellence Committee is CA Madam Preeti Savla. She is also the chairperson of the Sustainability Reporting Standards Board and the vice chairperson of the Valuation Standards Board. The vice chairperson of the Women and Young Members Excellence Committee is CA Shri Abhay Chhajar ji, and he is the chairperson of the Committee on Commercial Laws, Economic Advisory and NPO Cooperative, as well as the vice chairperson of the Accounting Standards Board. Before we proceed to today's session, I'd like to tell you about two more initiatives. The CA Women Members Excellence Awards are currently in a process where nominations are being accepted. These awards are to help our women members be recognized for the path-breaking work that they're doing in the profession, in industry, and in the society at large. So I urge you, on behalf of the Women and Young Members Excellence Committee, to go ahead and nominate yourselves so that everybody can know about the wonderful work you all are doing. The second initiative is the Women Placement Drive. It was started last year and we received an overwhelming response, which is why it is being conducted this year as well. Again, registrations are already open. So I invite all the CA firms, esteemed organizations, and women CAs to make the most of this opportunity. The last day to register is 17th October 2023. That's Tuesday next week. And we just have 6 days left to go. So please make a beeline for this opportunity. It really is a wonderful platform that our institute has given us. Moving to today's session. We have two extremely knowledgeable speakers today. And the first session is the session on annual compliances under the Companies Act 2013. And to conduct this session, we have CA Madam Sheetal Sharma. CA Madam Sheetal Sharma is the founder of her firm, and she's spearheading work in the area of direct, indirect taxes and ROC compliances. And her experience runs a rich gamut, right from internal audit to bank statutory audit, RERA registrations, as well as startup registrations. She also is the convener of the Bhayandar CP Study Circle of the Vasai branch of WIRC. She's extremely active at the study circle, having already served as deputy convener for 2 years in a row. She's also pursuing her LLB. And she is the apt person to walk us through this complex yet extremely important topic of annual compliances under the Companies Act 2013. Welcome, ma'am. Thank you so much for being with us today. And over to you.
Thank you, Jinal ji. Thank you so much for the lovely introduction. At the outset, I would like to congratulate both the chairpersons of Women and Young Members Excellence Committee, Preeti Madam and Abhay sir. As we are in the month of October, which is the timeline for complying with the annual compliances under the Companies Act 2013, it becomes utmost important for us to adhere to the compliances and regulatory requirements of that. Before that, I'll start with the PPT. Okay, so just for confirming, is my PPT or visible?
Yes, ma'am, it is.
Thank you. Before we start, there's a bit of disclaimer that any of the content that you are using from this PPT has to have relate with the current amendment that our MCA makes, and also the usable has to go through the particular acts and the rules that it specifies. So the index part is what we'll be covering in this PPT is type of compliances that we have to make, annual compliances, event-based compliances, maintenance of books and records, share capital and debenture, charges, deposits, management and administration, introduction of MCA version V3, compliances under it, the registration, how do we register, how do we comply with it, amendments due to the migration of the portal, and Companies Incorporation Amendment Rules 2023. Now, moving with this, firstly, whenever a company is incorporated in India, it has to have the compliances starts right from there. It has to have the compliances. Otherwise, the non-compliances would result in heavy penalties, and the news around us are being circulated with the heavy penalties being levied on the auditors, the directors, and the company itself. There's a saying, if you think compliance is expensive, please try non-compliance. So with this, we begin with the first compliance part. It is like it regulates, the Companies Act regulates the appointment, qualification, remuneration, resignation of the directors of the company. It deals with how the conduct of the board meeting, the shareholder meeting should be, how your AGM should have been conducted, and also the preparation and the presentation of your financials along with other documentary reports. The timely filing of ROC forms has to have it gives sort of confirmation to the stakeholders that the company is complying with all the regulatory requirements. So here, understanding of the classes of company to which it relates is first important, and second is what type of compliances will fall under those particular companies. So here we have divided it into two, that is private and public, and for listed companies there are n numbers of compliances that we shall not be dealing as there is a paucity of time, because the act is huge and to comply it in 1 hour is not possible. So for listed company, there is annual, quarterly, half yearly, event based compliances. For public private, it is annual compliances, that is filing of your annual returns, and event based compliances. And when something that the management wants to decide upon has to intimate it to the ROC. Moving forward, what are the annual compliances? We are being hearing from the topic itself that there is annual compliances. So annual compliances is filing of your AOC 4 financial statements, annual return of MGT 7/7A for OPC companies, DIR 3 KYC that we just did on 30th September, DPT 3 that the compliance has already been done on 31st July extended date, otherwise it is 90 days from the end of financial year. Each of this component, what we see right now on the screen, is discussed in detail in coming slides. There is BEN2, that is beneficial, significant beneficial owner has to have given his declaration. The company should have intimated it into the returns. And there is, of course, our ADT 1 appointment of auditor. Annual compliances is governed, that is, you have to have AGM first, and the section governing it is 96. The first AGM should be held within 9 months from the end of financial year. Subsequently, it should be 6 months, which is why it falls on 30th September every year. The gap between the two should not be more than 15 months. The extension can be sought for subsequent AGM, but not for the first AGM. Remember this always, because the first AGM decides upon the various factors that the company has to run into. So there is no extension for the first AGM. It has to be compulsorily conducted. And for the subsequent, you can seek an extension by writing it to the ROC, intimating it in the form. The form is GNL1, board resolution, and giving a appropriate reason to it by giving an extension letter to it. Maximum 3 months can be extended for it. Now, before we move on to the AGM, the board of directors has to give you a notice, clear 21 days notice has to be served for conducting the AGM, for calling for AGM to its members, to its auditors, to the persons who have indeed various stakeholders who are associated to the companies have to be intimated prior 21. Clear notice has to be given. If you, for example, if your this 30th September is your AGM date, 21 days before it has to be given, calling of the AGM has to be given. Now, every company first board meeting has to be conducted within 30 days. Why this is so important? Because this is the board meeting wherein the declaration by the directors of his interest in any of the other concerns, other companies, has to be taken on records. Also, the auditor, the first auditor appointment will also happen in this board meeting itself. So, conduct of board meeting has to be given in 30 days, and the resolutions has to be passed upon it. How many board meetings? The section states that there should be minimum 4 board meetings, bearing the fact that small companies can have not they are not made compulsory to have 4 board meetings. So the gap should not exceed 120 days. In case of OPC and small company, each calendar year they can have the meeting, and the gap should not be more than 90 days. So the for understanding how do we conduct a meeting, it is important for us that what class of company we are, if we are OPC, small company, or we are private public listed companies. Now the annual returns, the due date is nearing, so we have to comply with the AOC 4. Now AOC 4 is also slash, we can say that AOC 4 XBRL. Now to understand what is why, on which companies it is applicable, it is applicable on the listed companies or the companies having paid up capital of 5 crore or more and turnover of 100 crore or more. So XBRL, a notable point in this is, if it is once applicable, it is applicable throughout. It's not like that if you fall within the threshold limit, it will not be applicable to you for that financial year. It is applicable throughout. So once you are in the limit of purview of XBRL, you have to file XBRL throughout. And when do we file this AOC for? It is 30 days from the date of AGM. Annual return is governed by section 92. It states that you have to file your MGT 7A for smaller companies, OPC, within 60 days from the date of AGM. Now, there is one more notable point out here is listed companies, although we are not covering, but just to give you an information on it, they are required to have MGT 8 certified by practicing company secretary. It has to be filed by all the listed companies and companies having paid up capital of more than 10 crore or more and turnover of 50 crore or more. So this form will be accompanied with your MGT 7 form. So please make a note of it. Any of the compliances that we are doing as a statutory auditor, we are making sure that these compliances are being dealt with. Also, when we are incorporating a company in India, for us, it has to be, we have to see the various compliances that the company has to go through. So in form INC 20A, that is the declaration of commencement of business, has to be filed within 180 days from the date of incorporation of the company. So this point, as well as the conducting of the board meeting, has to go hands in hand so that the resolution numbers can, what we write in the form, e-filing ROC forms, is matching. So here the why the AGM is necessary, because it gives the stakeholders a chance to review through the financials, to know the company how it is conducting. Also, a company has to file the forms with MGT 15 with ROC for the listed companies compliances. They have to file how they have conducted the annual general meeting also. Moving on to deposits. Deposit is somewhere it came, and now it is mandatory for us to file everything as per this definition what the Companies Act gives. It covers everything that the company takes. They classified first it into deposit and then they eliminate it. So first everything falls under deposit. Then as per the act, there are exemptions provided. So we look after for the exemptions, or the other definition that subclauses the deposit section contains. Thereafter we eliminate those things, and there after that we report the same in form DPT 3 to ROC. This form gives the audited figure. This is the notable point regarding this form. It has to be filed within 90 days from the end of financial year. But there are certain companies for whom I have termed as eligible companies under Section 76. So whose are those? Whose network or is not less than 100 crore or more, turnover not less than 500 crore or more. Special resolution has been passed in general meeting. Why special resolution and not ordinary resolution? Because ordinary resolution always have classifications of 4, and apart from them anything that you want to do, and the main area why this deposit was to be reported is to protect its stakeholders, that the company while they go into litigations or something, the deposits are so huge that the other creditors of it does not get anything, because they are the ones who are covering the major area, which is why this was taken into consideration by Ministry of Corporate Affairs and made it mandatory. Either you file a nil return if your company does not have any deposit, but otherwise you have to have the particular criterias are mentioned in the form, wherein you have to tick the radio button and classify it under the heads. The same will be now, since the portal is into version 3, the mapping becomes easy for ROC. So please make sure that while dealing with this form, it is being dealt with utmost care. This company, the special resolution has to be passed for other companies, but this company has been given an exemption that they can do so by passing an ordinary resolution in the meeting. And all these forms has to be given in MGT 14 with ROC, that is filing of any agreements or the resolution passed by the board, and get the approval of this same. And then it has to be filed within 30 days. The time limit is 30 days by passing the resolution, authorizing your directors who shall be signing the forms. So deposits, also the limits of the deposit applicable to certain class of company we'll be dealing in subsequent slides. Now our main part, audit and auditors. Section 138 deals with internal audit that has to be appointed within 6 months by audit committee. For obviously it is compulsory for listed companies. Audit committee will keep an internal auditor who will look after internal audit affairs of the company. For public companies which are not listed, paid up capital of 15 crore, turnover 200 crore, outstanding loans and borrowings 100 crore, and deposit 25 crore. For private companies, turnover 200 crore, outstanding loans and advances 100 crore. The appointment of auditors is governed by Section 139. First auditor to be appointed within 30 days in board meeting, as we already discussed it. Casual vacancy within 30 days, and to be confirmed in general meeting within 3 months. If at all it happens that an auditor, because of any reason, is not able to conduct the audit and it leads to casual vacancy, then it has to be recouped by keeping a general meeting and appointing new auditor in its place. Prior approval of audit committee has to be given. For public sector companies, it is 10 crore, turnover 100 crore, outstanding loans and advances 50 crores. As we already mentioned that an audit committee does all the approval things of the auditors. Form ADT1 has to be filed within 15 days from such appointments. For 30th September, if any company have hold his AGM, then 14th October, the coming 14th October is the date for filing of ADT1 or the ratification of the same. If an auditor resigns, then he has to file ADT3 within 30 days of resigning. And it has to be communicated well. Earlier, we used to write that there is preoccupation of other things. Now, the reason has to be stated very clearly. The reason being is those forms are not being accepted, and the what we say, the complaints comes that the only a layman language like preoccupation has been put forth. So considering that, it has to have a proper reasoning. MSME 1. This form was brought by Ministry of Corporate Affairs to safeguard the micro, small and medium enterprises. They have to file a particulars of all the current outstanding dues in form MSME 1 with ROC. The company has this liability to identify the registered vendors of it, whether they are registered in MSME or not. This act goes in concomitance with the Act of MSME Act 2006. When the suppliers are registered under this act and there is outstanding dues by the company to the MSME supplier, it must file form MSME 1. But as DPT3 is compulsory, whether it is nil or not, this form is optional. If your outstanding is there to your MSME vendor, then you have to file MSME 1. Then and then only you have to file MSME 1. If at all, the vendors goes to MSME Samadhan portal and register the complaints against us. So which is why this clause was brought by in the MCA to strengthen the provisions relating to delayed payment to MSMEs, and by providing maximum credit period and penal interest are also levied if it is delayed in the payment to them. So every company, the filing of this form is half yearly. From April to September, the due date is 31st October, coming very soon. October to March, it is 30th April. Once, as I already mentioned, there's no need to file if I have no transactions with MSME. But the notable point out here is a company has to have a proper communication with vendors, whether I am registered under the MSME or not. And how do I do that? A confirmation I can take on emails or any other valid mode of channels wherein I can ask them if they are MSME registered or not. Once, if the reply is affirmative, please ask for the certificates. Keep the certificates also with you. Market to your accounting channels that this MSME vendor is there. Also, the other point we can say, when the business differs, for example, in textile industry, the credit period is 90 days. So how will a company comply with 45 days? But if I and my vendor are into agreeing terms and we have signed a contract to it that, okay, this will be the clause, then 45 days clause will not apply, and that particular vendor will not be able to have its a payment within 45 days by whatever means. So he'll be able only to file on MSME portal Samadhan by after the expiry of 90 days. So this is like what we say, an exceptional point wherein the conditions of the business criteria are such that the MSME 45 days clause will not be applicable. Otherwise, if nothing has been mentioned, it is strictly 45 days. Now, we are moving on to the concept of beneficiary owners, significant beneficiary owners. The governing section is section 80 and 90 of the Companies Act 2013. Why do we think this section has been brought into, like we have to file this in our annual compliances? Is because of the fact is to catch an individual's name who does not appear in the registers of members and holds a significant beneficiary interest in the company. For proper reporting of beneficiary interest, AMC has notified the significant forms to file a declaration within 30 days of acquiring such significant beneficiary owner or any change therein. But what do we mean by significant beneficiary owner here is important for us to understand, since we have to file this form considering the fact that any individual who is holding a beneficiary position into the company. So as per the section given, section 90 gives this definition under subclause 1. An individual who is holding ultimate beneficiary interest of not less than 10%, read with section 89 subsection 10, but whose name is not entered in the register of members of a company, has the holder of such share. So this is what we mean by significant beneficiary owner. The reporting has to be done in form band 1, band 2, and the time limit for the same is 30 days. Now, this were our, I'm sorry, this were our annual compliances that we have seen in our previous slide, that the annual compliances comprises of your DPT3, your filing of ADT1, your annual forms, ROC MGT7A, BAN 1, BAN 2, then there was MSME. So these are our annual compliances. Now, the company, as I already mentioned, wherever I am passing any resolution or I'm getting into specific activity or change of anything apart what I was earlier doing, I have to report it to ROC for regulatory compliances, and the information is given to my stakeholders. So these are called event-based compliances. Now, what can be event-based compliances? There could be change of directors, resignation, appointment. So DIR 12 has to be filed for the same. Appointment, taking MBP1 from them. What is MBP1? MBP1 is taking of interest of the directors in other companies, that has to be taken through MBP1 and taken on records of the company. There could be change in register office within city or from one city to another within the same jurisdiction of ROC. For example, in Maharashtra, there are two ROCs, ROC Mumbai and ROC Pune. So if I'm transferring it from one city to another within ROC jurisdiction, then different forms are to be filed. If I'm transferring it from ROC from one state to another, then there are additional forms that has to be filed. And what are those forms? Let's discuss it now only. INC 22 has to be filed for change of office from one city to another. Thereafter, if I am moving out from one state to another, it has to go through MGT 14, that is passing of resolution and uploading it on the ROC portal. Within 30 days, a special resolution has to be passed. The company has to apply and get an approval from regional director for shifting its office in E-Form 23. The approval will be allowed after the approval. It has to file INC 28 and thereafter INC 22 within 30 days from the RD's approval. Then there is increase in authorized share capital. This has to be done within 30 days for a change of authorized share capital. And obviously this will also accompany with your resolution that you are increasing your share capital. Issue of share capital, right issue, preferential, private placement, all through pass 3. There is reduction. Then there is change in main object of the company. The company which is incorporated with certain clauses has its main object. Then it is changed. Maybe additional objects are being added. Then it has to file the form MGT 14 first. MGT 14, you can take it as every agreement that we get into, or we are passing any resolution, the ROC has to be intimated for the same. Because this is not STP form, rest any of the other forms can be STP and they are taken straight to process. So here INC 24 will be passed along with an explanatory statement. Since you all are changing your MOA, it has to have an explanatory statement, the certified true copy of special resolution, your altered MOA, AOA, and minutes of the meeting, affidavit from the directors. So make sure when we are doing this event-based compliances, the attachment to the e-forms has to be readily available and filed along with the forms. Now there is transfer and transmissions of shares and securities. Firstly, let's understand what is transfer and transmissions of share. A transfer of share is a voluntary act, as in if I want to transfer my share to somebody. But whereas a transmission takes place through the act, operation of law. For example, it is on the death of holders of the share, or in the event where the holder becomes lunatic or insolvent. Also, in case of transfer, the deed of transfer and the payment duty becomes mandatory as compared to transmission. The form that we will be using to file this and make it across to the for the regulatory compliances to ROC, it is SH4. You have to file SH4 for transfer and transmission of shares. Loans, guarantees, investment made by company, the governing section 186 that we all vouch for during our audits. And why it is so? Because the companies are being restricted to make certain loans and advances, investments. It can at most make up to 2 layers of investment companies. The section 86 of the Companies Act states that a company cannot directly or indirectly give loan to any person or body person, give any security or provide any guarantee in connection with the loans or any other person or body corporates, or acquire by way of purchase, subscription, or otherwise the security of any other body corporate. Exceeding limit is being also prescribed under this section is 60% of its paid capital, reserves and security premium, or 100% of its free reserve and security premium, whichever is more. So make sure this section, when we are dealing with the company, does not make any loans and advances guarantee to any person or any body corporates. Or even though if it is making, it has to pass the special revision. The same has to be brought to the knowledge of ROC, Registrar of Companies, and it has to be passed to special resolution. Also, maintaining of register under this section is also being prescribed. Even if a company is dealing in the above mentioned things, it has to be taken on records in form MBP2. The form MBP2 is a record of the compliance for the compliance of section 186. The contravention can lead to heavy penalty. It has both civils and criminal liability on the company and the directors. The contravention of the provision leads to minimum 25,000, maximum 5 lakh for the company, 1 lakh for the every officer in default. Maximum 2 years imprisonment can be done. So this is why, from the perspective of auditor, also this section becomes utmost important for us to vouch for. Now there is exercise of borrowing by the board, section 180. Section 180 of the Companies Act restricts the power of the board that to take loan. Even if they want to, there has to be special resolution, explanatory note to it. Loans to director, the governing section is 185. Appointment of key managerial persons. So this appointment is governed by who are key managerial person. First of all, we have to look that the company, in company, it can be MD, managers, CEO, company secretary, whole-time director, CFO, and such other officers designated by the board as KMP, but should not be more than one level below the directors in whole-time employment, and such other officer as may be prescribed. So this KMP appointment has to be noted, and the maintenance of record has to be there. That we'll see in the subsequent slide. We have mentioned it. There is an appointment of company secretary. Creation, modification of charge, will deal with this separately. Maintaining of AGM records and minutes as per the standard 1 and standard 2. Maintenance of statutory books, register minutes, binders, and other documents along with the place of maintain and the custody of the same. What do we mean by place of maintain? Usually what we understand is a company's document would be at its registered place of business. If it is not keeping at its register of place of business, then it has to intimate ROC pre and before, for making it into the knowledge of the person coming to vouch for it, that some documents are there in the additional place of business as well. Maintenance of books and records. The governing sections has been given. The formats have been prescribed. The mentioning of the names, the dates are also being given as per the sections itself. So there is minutes book. One more notable point that we have come across is the minutes book are being signed immediately. So this should not be the case. On the day of the meeting has been conducted, the minutes are to be signed on the subsequent, because what we write is that the previous resolutions has been adopted by the company in the coming meetings. So please make sure that this particular point has been complied with. Also, the putting it under the register is also important. The date has to be mentioned when it was adopted and when it was registered in the register book. Then there is register of members, because of which if there is no name here, then one comes into picture. Register of director and KMP, register of debenture holder, register of charges, register of loan guarantee security that we already discussed in MBP2, it has to be noted down. Dealing with share capital and debentures. Section 56(1), transfer of shares, transfer deed, SH4, payment of stamp duty. The stamp duty is 0.015% by way of ESBTR or General Stamp Office. Like many a times they used to file this from GRAS, but if you're filing from this, it would be of much help. The governing section of delivery of certificate is section 56, to subscriber on allotments of shares, on transfer of shares, on issue of debentures. Section 71 deals with debentures. The form to be filed with ROC is PAS3 within 15 days. So usually, more or less, the time limit for any form to be filed is 30 days from the date of resolution. But there are specific form like this one, ADT1, that has to be filed within 15 days. Application money received before 30th, the status, why this has been brought in, because there were many amendments going on from 2013 to 2019, which is why deposits also came during this period. Only MSME came during this period. So this has been given what we call as sort of exemptions, that they have to comply within this. Otherwise, there will be 12% per annum interest will be levied on this same. The non-compliance for the same is the amount raised or 2 crore, whichever is lower. If this particular sections are not being complied with, the limit is 2 crore or the amount whatever you have raised. Now the charges. The company, while taking security loans, keep a charge on certain assets of the company. So those has to be filed with ROC. The time limit is again 30 days. And this has to be, while we are creating a charge, it has to be filed. When we are satisfying the charge, then also it has to be filed to make it on the records of ROC that this particular charge has been satisfied with. So the governing sections are ranging from section 77 to 78. Every company requires, it covers everyone. Earlier, we can say that there are specific forms that has to be filed for only listed company, public company, private companies, but this has to be filed for every company who creates charge on its property or assets or any of its undertaking, whether tangible or otherwise, situated in India or outside, shall file CHG1 charge. Okay, the wonderful point about this MCA filing form is whatever the creation, the nomenclature used in for the form coterminons to your creation of the understanding of your clauses. So charge CH1 charge and CH9 in case of debenture within 30 days of its creation. If it is created on 1st August 2000 on or before, it shall be registered within 300 days from its creation. The charges would be normal fees because there was glitches in the portal, because of which the MCA via its notification has stated that if you all are filing within 300 days, normal fees would be levied. Within 6 months, additional fees would be levied. It is like twice the time, 12 till the 12th time. Thereafter, there is ad valorem fees or could also be levied. So these are the bifurcation if we are doing it on or before the 1st August 2023 to 2019. If the charge is created post that, there is a 30 days limit only. For 60 days, it is additional fees, and thereafter it is ad valorem fees. Now, this is what I have told you earlier also, that the deposit, what a maximum deposit a company can take is been tabulated before you. So we have eligible companies that we already discussed the limit of it. They can have the maximum limit of deposit accepted is 10% paid up share capital, free reserve security premium of the company. Eligible company shall accept or renew deposit from other than members. Other than members who are not on the records of registrar of members. 25% of the paid up capital, free reserve, security premium of the company. Any company as per section 73(2) accepts or renew any deposit from its member if the amount of such deposit together with the amount of other deposit outstanding as on the date of acceptance or renewal. 35% of the paid up share capital, free reserve and security premium. Specified IFSC public companies and a private company may accept from its member 100% of the aggregate of the paid up share capital, free reserve security premium. Government company 35%, private companies, which is a startup. So uh, again, there are few companies who can avail for maximum 10 years. Certain benefits have been prescribed for startup ventures. So they can utilize this thing. So this is because of the obviously the tie-up with the government, tie-up with the Ministry of Corporate Affairs. So the private companies, which is a startup company, who is not associated or a subsidiary of any other company, can borrow from banks or financials. If its borrowings are less than 50 crores rupees, whichever is less, and such company has not defaulted in repayment, it should not have defaulted in the repayment of such borrowing subsisting at the time of accepting deposit. So there is no limit for startup companies. Now we are moving on to administration and management. So this is governed by section 94, that is the preservations of record. And also we have seen on the event based compliances that whenever I'm moving from my one registrar to another, it has to be followed through this section and the filing of the forms with ROC. So records has to be preserved at registrar office, register of members, other members and returns. To maintain any at if I want to go, maintain the particular documents at any other place, then more than 1/10 shareholders has to give it assent to it. Special resolution should be passed. Advance intimation to ROC, as I already told, NGT 14 is the form wherein you file every of your agreement, your resolutions with ROC. Then there is section 102, explanatory statement to have interest of all the directors, APM and their relatives, that is MVP 1, you take from 30 days from your board meeting, first board meeting, and thereafter every time on renewal you have to take it. Section 384, section 92 shall apply on foreign companies as well. So they have to file annual return. The form is FC4 and the time limit is 60 days. So even foreign companies have to comply with the annual return compliances. We have already discussed about holding of AGM and board meetings. We have discussed the time gap, everything. Now comes the quorum, because of not, if the quorum is not complete, the validity will not happen, and it has to conduct again on the same day, same place. So these are the provisions of conducting board meeting. So quorum has to be there. For private limited companies, it is two members are sufficient. For public company, 5 members up to 1,000 members, 15 members up to 5,000 members, 30 members up more if more than 5,000 members. Section 120, read with Rule 27. Maintenance of documents, records, register minutes in electronic form. So, if we can link it to our audit also, we are stating whether they are into physical forms or electronic forms. So electronic forms are also allowed, provided we are complying with the section and the rule related to it. So here it is Rule 27 has to be complied with. Section 121, read with Rule 31, report of AG on AGM. This I have already mentioned before also. It is NGT 15 for unlisted companies. Secretarial audit, section 204, read with rules. Secretarial auditor has to be appointed and the audit form has to be given in the prescribed form. This is applicable to. Oh, welcome, Preeti ma'am.
Thank you.
Welcome, Preeti ma'am. Just thought we could connect with you for your comments about today's session.
So how much time, Sheetal? Once you complete, I will comment. Yeah.
Okay, thank you, ma'am. So,
Thank you,
secretarial
ma'am.
audit report from an independent practicing secretary has to be taken. It is compulsory for every listed company, every public company having paid up share capital of 50 crore or more, a turnover of 250 crore or more. Now, as I already mentioned, that the registration under MCA version 3 is a bit difficult and a bit confusing. So I thought to give you a glimpse of it. Register yourself in version 3 portal, create your login ID. There are two types. You can be registered as registered user or business user. So what is the difference between the two is those can only use two functions, and the business user can have access to all the filing of all the forms. However, the professionals user in version 3 were earlier termed as practicing professionals in V2. We also have to register our DSC appropriately on the portal. Even if it was registered earlier, please re-register it again. Now there are some amendments. It was brought into force from Feb 23. I know the portal still has glitches, but there are when there is a problem, there is a solution too. So in MC 21, circular number 3 oblique 2023, due dates have been extended for filing certain forms that has to be complied. Also, nowadays, the company, the ROC, the registrar of companies, is making sure that whatever things we do is given with the particular photograph of the directors, his OTPs, emails is also registered. Those who have done director KYCs might have understood this, that we are being using, if it is first time register, we are filing full form, otherwise we are doing it through the OTPs. So the confirmation gets that to the stakeholders that this is a particular number and mobile number of the email ID and the mobile number of a particular director of a company. And there is disqualification is also given. The DIN numbers gets deactivated for non-compliance. Charges has to be required to obtain an NOC from the charge holder along with the secured creditor. As I already mentioned, satisfaction of charge, the form has to be filed. It has to be uploaded within 30 days and get through it. Your charge will not be seen on the MCA portal page. Spice INC 32 nominee of OPC details in MOA and shall file such nomination while filing the form for its incorporation. Documents and resolution related to the prospectus are to be filed using GNL and MGT 14. Coming to Companies Incorporation Amendments Rule 2023, there are now EMOA. There is no drafting. There are only limited clauses to be put. So with this, there are what we say there is a standardized format has been given by the Ministry of Corporate Affairs. So these are the particular pointers wherein you can put your object clause and your articles of associations clause. We have to use NIC code for business activities with 5-digit introduced need to be provided for object clause in wiki. Trademark validations has been done. The whatever name we were applying for first used to be approved if trademark is not there. But nowadays it has become more of a thing that you have to comply with the copyright names, trademark names, and names similar already existing to certain companies. You have to give NOC as well at that time. All first subscribers and or directors who have affixed their DSC are required to get themselves registered as business owner. This I already mentioned that we have to re-register our DSC as professionals also. Now, these are some of what we say. Sorry. The changes while incorporating the form. So ROC has omitted it for certain forms and has been resubstituted with different forms. So now the approval goes to name approval goes to form run, and there is INC 6 and so on. So this slide is just for your reference purpose. Whosoever was dealing with earlier with the previous form has to deal with now the new forms and certain additional compliances. With this, I complete my annual compliances of the company. Thank you. Any questions from the members? Maitriji, I think you are mute. You're still not audible, Maitriji.
No, Maitri, still can't hear you. So while Maitri is fixing the audio issue, Preeti ma'am has joined us and we are graced with her presence. So Preeti ma'am, could you hear us? Preeti ma'am?
Am I audible now?
Yes,
Yes.
Maitri, you are.
I think
Yeah, Maitri, go on.
Yeah, so let's continue with the questions. Currently there are two questions that we have. The first question is, if a director of a private company asks for reference book which she can follow to ensure that compliances are being followed properly, which book can be referred?
Can you please repeat the question?
Yeah. So if a director of a private company asks for reference book which she can follow to ensure that compliances are being followed properly, which book can be referred?
You want book to be referred? I would rather say please go by the section that governs a particular compliance of the act. That is from section 88 to there are also other sections that has been shared in the slide. So please go on those particular sections only, though they will be best person to guide, best person not indeed, but they are the best particular references that you can make to have the register maintained. So let me share the slide with you so that you get a better clarity of the same. See, these are the governing sections for any of the register that you have to maintain. Please refer this particular sections.
Yeah. So, madam, the next question is how to apply for extension of name approved during company formation?
The period that they provide is already 30 days, I guess, for name approval, within which if you apply your company's incorporation other forms, then it will be allowed. Otherwise, it is not allowed. Once the time lapses, they will you have to reapply the forms again.
Okay, noted, madam. The next question and the last one is, are there different compliances for non-profit companies?
Section 8 companies have different compliances, but the annual compliances remains the same. That is filing of your AOC 4 and NGT 7.
Okay, so there are annual compliances plus some additional compliances for non-profit organizations.
See, already what we understand by the word compliances is there is annual plus event-based compliances. As and when something of the resolution or agreements that the company gets into, they have to intimate it to the ROC.
Right. So
The main agenda what the Ministry of Corporate Affairs feel is that they should be aware about the activities of the company.
Right.
So that its stakeholders are safe. The interest of the stakeholders are safeguarded.
Okay. Noted, madam. So I think we are done with the questions, and now I will move on to vote of thanks. So on behalf of Women and Young Members Excellence Committee, with great pleasure and gratitude, I extend a warm and sincere vote of thanks to our esteemed speaker, CA Sheetal Sharma. Madam, you have covered the topic in depth, starting from the types of compliances, the timelines, the forms, also covering certain event-based compliances, then maintenance of books and records, deposits, and many other relevant topics, along with the amendments. Madam, we are truly honored to have this opportunity to learn from you and the expertise that you carry in this crucial subject matter. Considering the due date to adhere to these compliances is approaching soon, that is October this month. We are grateful for the time and effort you have invested for this webinar. Thank you once again for gracing us with your presence and expertise. I would now request Falak Dedia to introduce our next speaker, CA Archana
Before that, I
Kshatriya.
would like to take a moment, please.
Sure,
And offer my, I would take this opportunity to offer my gratitude to Preeti ma'am. She was the one who gave me this opportunity, and which is why I'm here today. A big thank you to you, ma'am.
You are always welcome, Sheetal, and it was nice presentation. I was there for some time, so I can see that and feel that, and all the participants have also learned a lot with this presentation. So thank you so much.
Thank you, ma'am.
Let us move forward. I also want to discuss some certain developments of Women Members Excellence Committee. So let us discuss. Sheetal, I request you to please close your screen, stop sharing your screen, so then I can discuss with all my dear participants certain developments about Women and Members Excellence Committee. So our today's next speaker is Archana. So friends, I'm very, very happy to share with all of you that today we have opened up the nomination forms for application of first ever CA Women Excellence Award. So this time, yesterday only we have got it approved by the council. Yesterday's council meeting, 425th council meeting, we have got it approved for CA Women Excellence Award, and this is happening for the first time. I request office, if office Ruchi or Shanu or Jaya who is present, to please share the brochure of one-pager brochure for awards on the screen. So the nominations, there are 6 categories of the awards: Women Lifetime Achiever Award, CA Women Independent Director Award, then CA Women. I'll just open the brochure and tell you by the time they are putting on the screen. CA Women in Social Service Award, CA Women Value Creator Award, and CA Women of the Year Award, CA Women Startup Award. So these are the 6 categories, and I request all of you to fill the nomination form, and I wish maximum nominations to come, and there will be there are 6 categories and 2 awards in each category. So we'll be awarding the 12 members. The award ceremony will be happening at Mumbai on 19th of December. So these are the basic things of awards. We have also started with the flexi working and part-time working. Ruchi, are you there? Who is there from office?
Ma'am, please wait. I'm sharing the brochure.
Please, yeah. Again, we have also started uh, flexi working. This last year, we have taken the initiative and started the special campus placement program for CA women on flexi or part-time work basis. And this year, this is the second year where we have already started with current year. More than 100 requests from the women, CA women members have come. And 17th October is the last date for applying for the women. The main, see, we have fresh, CA fresh who qualifies freshly. For them, the campus placement. Again, we have another campus placement for all the members also, but this is a special category for CA women on flexi work hours or part-time basis, work from home basis. So however, this is only for job and this is not for the CA women who are holding COP. So if you want to apply, if you are having the COP, it is not possible for you to apply. You have to surrender your COP first and you can apply. So friends, I request all of you, if you are looking for part-time or flexi hour basis, so please open this, please apply for the job for that. Shanu, it is not seen entire brochure. Yeah. Entire full screen should be coming on the. So if you have any query, please feel free to ask. No, okay. We will be sending this through mass mail today or tomorrow. You'll be receiving this. नहीं, एक स्क्रीन पे पूरा आना चाहिए ना, एक पेज बड़ा करो ना स्क्रीन. See this. या कम डाउन. नहीं इतना छोटा दिख नहीं रहा है. ये ऐसा मत दिखाओ आप पूरा ऐसा. ये दिस इज नॉट द करेक्ट वे टू शो. This is not the correct way to show. Who is showing this? Who is showing this? How we can show in this manner? So we'll be sending through mass mail and SMS also the link for nomination. For flexi hour or part-time work basis or for this nomination for the award. If you have any question, please feel free to ask. I don't have at present the link of participants. Do you have any link? Office, please share with me. I am not able to see the participants' details.
Ma'am, there was one website that was referenced, wmec.icai.org, as the link where people can apply. The women CAs can apply to be part of the placement drive.
I request office to please put in the chat box the brochure and the link for application, the portal link for application of awards. Please put in the chat box. Can I get any response from office? Who is there from
Yes,
office?
I'm doing typing, just typing.
आप प्लीज आप आपका वीडियो ऑन कीजिए. Who is there from office? आप थोड़ा रिस्पॉन्ड करिए तो अच्छा लगेगा ना. और थोड़ा अच्छे से ब्रोशर बताइए सबको. दिस इज नॉट द एनीवेज. आप एट प्रेजेंट प्लीज शेयर द लिंक ऑफ ब्रोशर. आप ब्रोशर पे चैट बॉक्स में डाल दीजिए और लिंक फॉर नॉमिनेशन चैट बॉक्स में डाल दीजिए एंड कैंपस प्लेसमेंट का भी लिंक डाल दीजिए एप्लीकेशन का. So,
Okay, ma'am.
I request all of you to please take the benefit of all the initiatives. आप है ना थोड़ा लिखिए किस चीज का लिंक है. वेर इज शानू एंड वेर इज रुचि. आप क्यों ऐसा कर रहे हो? What you are sending, put properly in the chat box so that everyone can understand.
Okay, ma'am.
I request, so this is our 74th episode of Sky High Symposium, friends. And each month we are doing at least 5 sessions. Next week, next Wednesday will be 75th Symposium. And friends, I request all of you to please take the benefit of this symposium. And if you want to participate as a speaker coordinator, you are welcome. Today we have 2 speakers, C. Archana Kshatriya, C. Sheetal Sharma. So I congratulate and compliment them for being speaker on this platform. And I also thank all my dear coordinators, C. Jinal Maru, C. Maitri Vikam, C. Falak Dedia, for being there coordinating this session, and my office team for being supportive in all the initiatives. I appreciate Shanu, Ruchi, Jaya, and entire team. With these words, I am sure that our members are enriching in their knowledge and getting the benefit and recognition. Our initiative is to recognize the women, motivate the women in the profession for the benefit of them. Thank you very much, and over to Gina.
Thank you, ma'am. Thank you so much. It's really nice that we have such wonderful initiatives to encourage our women members and recognize all the wonderful work that they're doing. We'll move on with the session and I'll hand over to Falak.
Yes. Hello, everyone. Here, Rachana has qualified her exams in 2022. She has been associated with several coaching classes, with teaching subjects from various disciplines such as business laws and economics. She is presently associated with KBB and Associates, and she is an ardent reader of classic literature. So I would like to CA Archana to start the presentation. You are on mute.
Yeah.
Archana. Thank you.
Firstly, thank you so much, Mr. Falak Deria, for the kind introduction. Before I begin my session, I would congratulate CA Sheetal Sharma for such a succinct and informative first session. Now, I acknowledge after an hour-long session, it must be a little difficult for the viewers to attend another successive session of another entire hour. So what better way to gain your undivided attention than to narrate a story? Now, I am obviously not going to narrate a folklore or, as Mr. Falak just mentioned, a literary story, but instead, I wish to narrate the story of how capital gains taxation actually came into existence. What was the origin of capital gains taxation? So for that, I take you on a journey with me to the budget of 1974. So just a minute, I will quickly share the screen. Yeah, can someone confirm if the screen is visible?
Yes, it is visible.
Okay. So firstly, let us now move on to the budget of 1947. In this budget, it was for the first time that capital gains tax was introduced by virtue of Section 12B, which was inserted in the then Income Tax Act of 1922. Now, what was the reason? Why was this new form of taxation altogether inserted? Well, the sheer reason was to control the speculative activities of constant buying and selling of assets in an already inflationary environment. In order to deter such speculative activities, a new form of taxation was proposed through the insertion of Section 12B. Now, of course, the constitutional validity of this section was challenged, and the contention raised, the ground raised for challenging this particular newly introduced taxation was that introducing this new form of taxation was ultra vires to the powers of the central legislature conferred to it under the Entry 54, List 1, 7th Schedule of the Government of India Act 1935. However, the Apex Court upheld the validity of this particular newly introduced taxation in Naveen Chandra Mafatlal, and then the capital gains tax was finally introduced. But the lifespan of this taxation was very short. Subsequently, in the year 1949, this capital gains tax was abolished. So it lasted for a mere span of 2 years. And the reason why this taxation was abolished was because it was believed that on account of, or rather due to introduction of this new form of taxation, there has been an adverse impact on the stock markets. So in order to ensure that the adverse impact on stock markets is discontinued, this capital gains tax was abolished. But this abolishment again was short-lived, because through Finance Act number 3 of 1956, on the recommendation of Professor Nicholas Kaldor, capital gains tax was again reintroduced. And 2 reasons were given for the reintroduction of it. The first reason that was given was principle of equity in taxation, a pretty fancy term. So what does it actually mean? Well, it simply means that as your ability to earn income increases and your ability to pay increases, so should your taxation also increase, right? I would repeat myself again. It simply said that as your income increases and as your ability to pay increases, so should the taxation also increase. That is nothing but the principle of equity in taxation. And the second reason which was given for reintroduction of capital gains tax was augmenting tax revenue, which is nothing but filling up the state coffers. And after this, the capital gains tax became an integral part of the taxation regime of India. Subsequently, several amendments were introduced, a lot of changes were proposed, such as in the year 1992, the then Finance Minister, Dr. Manmohan Singh, proposed a budget wherein indexation on long-term capital gains was introduced. Now we are well acquainted with the usefulness of indexation. Through indexation, the impact of inflation is neutralized. Subsequently, again in 2004, the then Finance Minister, P. Chidambaram, provided an exemption on the long-term capital gains earned from listed securities, and instead proposed a new form of taxation called STT, or the Securities Transaction Tax. The impact, or rather I would say the positive impact this had on the stock market was truly enormous. The stock markets between 2004 to 2018 witnessed 5 times growth, tremendous growth. However, again, in Finance Act 2018, this exemption which was prevalent was withdrawn, and a reintroduction of long-term capital gains came into existence. So I hope everyone is now quite wide and awake and I have your undivided attention. So we now realized how capital gains tax was born, right? The origin of it. Now let us try and understand, how does capital gains tax actually arise on a given set of transactions, or rather, which transactions would attract capital gains tax? And for this, we will have to refer section 45 subsection 1 of the Income Tax Act, which is nothing but the charging section. And this is section 45 subsection 1. Now, just to summarize, it simply says, the section simply says that for capital gains tax to arise, 5 conditions must be satisfied at the same time. Okay, so if 5 conditions are satisfied, then capital gains tax will arise. The first condition is there should be a capital asset. Existence of a capital asset is of quintessential importance. So what is a capital asset? Well, it is defined under section 2, clause 14 of the Act, and we'll refer that in some time. The second condition that the charging section says is that a transfer must take place. This particular capital asset must be transferred by the assessee. So again, the question arises, so what is the meaning of transfer? Well, the meaning of transfer is defined under section 2, clause 47 of the Act. The third condition is that such transfer must take place during the previous year. Fourth condition says that any profit or any gain arising from the transfer of such a capital asset occurring in the previous year will be subjected to taxation. The fifth condition is that such profit or gain, which we just discussed a while back in condition 4, it should not be invested in the modes prescribed under the sections listed under 45 subsection 1. So there are several sections that are mentioned under section 45 subsection 1, such as section 54, 54B, 54D, 54E, etc. and so on. So if at all the profit or the gain arising from the transfer of the asset is invested in any of the modes prescribed in these sections, then in that case scenario, taxation won't arise. However, if it is not deposited and with the satisfaction of all these 5 conditions, the capital gains tax will arise on a given set of transactions. Now, one very peculiar feature of this capital gains taxation is that usually for the other heads of income, as mentioned in section 14 of the Income Tax Act, the other heads of income, the income arises through the exploitation or the utilization of a particular asset. However, in capital gains, that very asset is sold or is transferred. So there is no utilization or exploitation of an asset, but instead the asset itself is transferred or sold. Now that we've understood the conditions that will trigger a capital gains tax, let us first of all try and understand the meaning of capital asset as defined under section 2, clause 14 of the Act. Now, I'm sure you've come across this definition several times, but I wish to invite your attention specifically to the first part of this definition. So section 2, clause 14 begins with the words, property of any kind held by an assessee, whether or not connected with his business or profession. And in that too, the very important words that I want to highlight is property of any kind held by an assessee. Now, this definition is extremely wide. It has a very wide coverage. When it says property of any kind, it could mean a tangible or an intangible property, a corporeal or an incorporeal property, a physical or an abstract one. It could mean an interest in the properties or rights attached to the properties. So it has a very, very, very wide coverage. But then section 2, clause 14 shies a little. It takes a step back and puts forth certain exclusions. The exclusions have been mentioned here for your reference. One of the exclusions here is personal effects, right? So wearing apparel, furniture, etc. The capital asset, or rather section 2, clause 14, excludes it from the definition of capital asset. But then again, to this exclusion, there are certain additional exclusions, which is basically that if the personal effect comprises of jewelry, archaeological collection, drawing, painting or sculpture, or any other work of art, then in that case scenario, we will not consider it as a personal effect and it will be considered as a capital asset. Now, there is a very interesting case study that I want to discuss with you, which is CIT versus Siemens and Nixdorf Information Systems. In this particular decision, the facts were as follows. the assessee company lent a certain sum of money to its subsidiary. Now, the subsidiary company fell on some pretty bad times, and the assessee company decided to sell this particular debt to a third party. The debt which it had lent to its subsidiary, it decided to sell it to a third party. And what it did is basically the consideration that the assessee company received from the third party, it considered it to be the full value of consideration received. And the amount of debt which it had originally lent to its subsidiary, it considered it to be a cost of acquisition. And the gain arising therefrom, it offered to tax under the head capital gains. Now, this was contested by the assessing officer, and the matter reached up to the Bombay High Court. The Bombay High Court held that this particular transaction was itself, or rather offering the taxation under the head capital gains, was absolutely correct and valid. And one interesting observation that the High Court made in this particular decision was that the meaning of the word property has a very wide connotation, and it includes interest of any kind. So even a debt which was given to the subsidiary company when it was sold to a third party, and the amount that was received therefrom, even that was offered to capital gains and was accepted, and it was considered as valid. Now that we've understood the meaning of capital asset, let us try to test this definition on some distinct critical issues. The first of them being development rights. So what is the meaning of development right? Now, I understand that a lot of content is present on your screen. So what I would rather do is I will take an example and thus explain you the meaning of development right. Let us take a hypothetical situation wherein I live in a society which has 6 floors, constructed. But the society has the right or has the ability to construct another set of 8 floors. So the society can in all have 14 floors. Now these 8 floors, which the society has the right to construct, but it has not yet constructed, is referred to as FSI, or floor space index. Now what the society decides is, it decides to basically transfer this development right, to transfer this right to construct additional 8 floor to a developer. Now, what do the members of the society gain in return? Well, there are two things that can happen. There are two things that can happen in this case scenario. A, the developer may either demolish the entire building and construct an altogether new structure comprising of 14 floors. Or secondly, the developer may choose to add additional 8 floors to the already existing 6-story structure. Now, let us assume that the entire building was demolished and the developer constructed a 14-floor or a 14-story building. Now, what do the members gain in this particular transaction? The members of the society may receive cash consideration along with new flats in the newly constructed building, and there is a possibility that they may get some additional carpet area than their original flats. Now, what is the gain for the developer in this case scenario? Well, what the developer would do is, after allotting the properties or after allotting the flats in the newly constructed building to the members of the society, the developer will then sell the remaining flats to the buyers, and the revenue generated therefrom will be considered as business income of the developer. So in a very short and simple manner, this is how a development right is basically, takes place. Now the question arises whether such a development right can be called as an immovable property, or can a development right be considered to be a capital asset? Now for this, I have 4 points that I want to discuss with you. The first point is I recently referred a book, and I have shared the title of the book along with the authors and the edition for your reference. And while they were discussing the concept of development rights, they very beautifully provided certain observations. The first observation they made was that the ownership of land, along with the ownership comes several rights which are attached to this ownership. And development right is one such right, or rather a very important right. Secondly, this particular right can either be exploited by the owner of land himself, or he can transfer it, or he can assign this right to another person for the purpose of exploitation. The third observation they made was this particular right has the ability to be detached from the original land, from the original ownership of land, and can be freely transferred. So it, according to the authors, this was enough evidence that development right satisfied the requisites of the meaning of the term property, and therefore it is very well a capital asset as defined or as contemplated under Section 2, Clause 14 of the Act. The second point that I want to bring forth is the development control regulations of Greater Bombay. So under these regulations, the rules define the term transferable development rights, or as we call them generally, TDR. So while defining TDR, they say, what is a TDR? Well, a TDR is nothing but the development potential of a land which is separated from the land itself and which is available to the owner in the form of TDR. This is a development potential of the land which is separated from the land itself and it is available to the owner in the form of a TDR. Further, I intend to bring forth two case laws. The first one is Shakti Insulated Wires Limited versus JCIT. Now, in this particular case, Mumbai Tribunal held that development right is very well a right which will satisfy the conditions for property, and therefore it can be considered to be a capital asset under Section 2, Clause 14. But a contradictory view was also put forth by the Mumbai Tribunal in the case Jethalal D. Mehta versus DCIT. So, in Jethalal D. Mehta versus DCIT, the Mumbai Tribunal said, well, agreed, that development right is an asset. But this particular right is not acquired. This right is not purchased. This is a right which is arising on account of ownership of land. This is a right which is attached to the ownership of land. And therefore, if you want to charge it, or if you want to subject it to taxation, how do you ascertain the cost of this particular right? And then in this particular decision, a reference was made of the Supreme Court, the landmark decision of the Supreme Court in the case of CIT versus BC Srinivasa Shetty, wherein it was held that for a capital gain tax to arise, the computation method or the machinery which is put forth in Section 48 of the Act needs to be satisfied. And under Section 48 of the Income Tax Act, one point, or rather one particular requirement is cost of acquisition. So if you are unable to ascertain the cost of acquisition, how can you ascertain the capital gain? And by virtue of that, Mumbai Tribunal said, well, for the purposes of capital gains, this will not be considered as a capital asset. Now, I also have a very interesting case law to discuss with you. This is ITO versus Kirit Rauji Bhai, again, a matter pertaining to Mumbai Tribunal. Now, the facts of this case are pretty interesting. So there were two brothers, Mr. Bharat and Mr. Rauji Bhai, or Mr. Bharat and Mr. Kirit, okay? Let us call them as Mr. B and Mr. K. So both these brothers were co-owners of a plot of land. Now, they decided to give away this land for the purpose of development. So they did not sell the land, but they sold the development rights to a particular developer. Certainly, they received consideration for this. Now, one brother, Mr. B, what he did was he offered the income as capital gains. There, the assessing officer contested that this is not a capital gain, but instead it should be treated as an income from other sources. The matter reached to the tribunal, and the tribunal said, no, since development right is a capital asset, it very well qualifies within the definition of capital asset. And because of that, the income should be very well charged under the head capital gains and not other sources. However, Mr. K, the second brother, he did not offer this income to tax. And then this same matter came up before the tribunal. And the question was raised saying, oh, look, the facts are same. Now, in the case of Mr. B, what the tribunal said was that development right is an asset. On the consideration, gain was received, and this gain was subjected to capital gains tax. That was upheld, right? So now this person, that is Mr. K, has not offered the income to tax. He should have offered the income to tax under capital gains. And then the point that was put forth was, no, that is not the case. Again, B.C. Srinivasa Shetty was referred, and the point that was discussed again was that, well, it is not, it is agreed that it is a capital asset, but we cannot ascertain the capital gain. Reason being, cost of acquisition cannot be ascertained. So if the income is being offered, then it has to be offered under the head capital gains. But ideally, no capital gain will arise as such. So a very pretty interesting decision. So this is again with respect to transferable development rights. I have already discussed in great detail, but I'll just keep the slide for your reference for half a second maybe. Okay, we'll move ahead. Now there are certain legal precedents which are in support or which are in favor of the fact that where sale of TDR takes place, it will not be subjected to capital gains. One such decision is CID versus Sambhaji Nagar, CHS Limited of the Bombay High Court. Here, what happened was the Cooperative Housing Society basically transferred its development rights to the developer for the purpose of redevelopment, and it received certain consideration. Again, the point that was raised was agreed that this is a capital asset, but this was not acquired. This is a right which was attached to ownership, and the cost cannot be ascertained, and therefore it cannot be subjected to capital gains tax. A very similar point was held up in Landbreeze Cooperative Housing Society. And then these are certain additional case laws which also say that in the case of transfer or in the case of sale of transferable development rights, TDRs, the consideration received thereon will not be subjected to capital gains taxation. However, having said that, I wish to invite your attention to the words that I have mentioned with red font. With effect from AY 24-25, certain change has occurred, the resultant effect of which is going to be that TDR will also be subjected to taxation. At least that is what on the outset appears, that TDR, on the sale of TDR also, taxation will arise. So what is that? What amendment has occurred? What was the situation prior to this amendment? In order to understand that, let us now quickly have a glance on Section 55, subsection 2, Clause A of the Act. Section 55, subsection 2 basically defines the term cost of acquisition. It provides different case scenarios, and then under those particular scenarios, under those particular situations, circumstances, what should be the cost of acquisition that is defined. Now, under 55 subsection 2 clause A, except earlier, before this amendment, the words that are marked in red, that is any other intangible asset and any other right, were not present. In fact, if you see, tenancy rights is mentioned here. Okay. And as we move further, we are going to have a discussion on tenancy rights too. So please take note of that. So tenancy rights.
Archana, your video is paused. We are not able to listen to you. Archana? I think she need to log out from this. We'll wait for few time. Just wait for few minutes. If someone from the office may call her. Yes, Archana. I think there was some. Yes. Yes,
Yeah,
Archana.
am I audible now?
Yes, yes.
Yeah, I guess there was some technical issue.
Correct. You may continue, please.
Okay, I'll quickly share the screen again.
Yeah.
Yeah. Is this visible now? Are you able to view the screen?
Yes.
Okay. Just give me a moment.
Yeah.
Okay. So I'll continue again. Well, we were discussing section 55 subsection 2, right? So section 55 subsection 2 provides different case scenarios and the cost of acquisition that should be taken in these different case scenarios. And in that particular section, you have this clause A. Now, if you see, I know the font is in bold and in red, but for a moment, I would request you to just ignore it, pretend that it does not exist. And that is what was the provision prior to AY 24-25, right? So here you will be able to see tenancy rights. Now, the reason why I'm highlighting this is because this is going to be relevant to us in our subsequent discussion. So what 55(2)A says is, for the rights that are mentioned in this particular section, which is goodwill of a business or profession, trademark, the right to conduct a business, right to manufacture, tenancy rights, state permits, LUMARs, etc. For these particular set of rights, A, if these rights were acquired by way of purchase, then the cost of such purchase, you can take it as cost of acquisition. Secondly, it says, well, in case it is not acquired, but it is received by virtue of section 49 subsection 1, clauses 1 to clause 4. So what are these clauses? Well, they cover scenarios such as a dissolution of a firm, transfer of assets in the case of dissolution of a firm, liquidation of a company, by inheritance, will, etc. So if the asset is received, the above mentioned assets are received by virtue of section 49 subsection 1, clauses 1 to clause 4, then the cost of acquisition will be the cost to the previous owner. However, if you are in a situation where neither the first nor the second condition apply to you, then the cost will be taken as nil. This is extremely important. So let us try and understand the impact of it. It simply means that earlier, we often raised the contention that, well, a particular right arose because it was attached to another set of rights. This right was not acquired. I cannot ascertain its cost. Because I cannot ascertain its cost, it fails to meet the conditions or it fails to meet the machinery for computation of capital gains provided under section 48, and therefore capital gains cannot be ascertained and therefore no taxability will arise. But for such rights, section 55 subsection 2 clause A says, it's okay. You can refer to the condition number 3 and you can take the cost of acquisition as nil. And the impact is going to be that the entire consideration you receive by transfer of such assets will be directly taxable. Now, we referred to several case laws where we saw that transfer of TDR was not subjected to taxation, right? And that was because in 55 subsection 2 clause A, nowhere we found a transfer of TDR, or TDR was nowhere mentioned here. But with effect from AY 24-25, the words any other intangible asset or any other right has been introduced to this particular section. And according to my humble opinion and a very obvious reading of the act, it seems that now even TDRs could be subjected to taxation. The cost can be taken as nil for that purpose. Moving ahead, let us try and understand the other concept called as a right to obtain conveyance. So what is this? First, let us wrap our mind and try and understand the meaning of this term. Again, a hypothetical situation. I like stories, so I like to turn concepts into stories. I intend to purchase a particular immovable property. And for the purpose of purchasing this immovable property, I enter into a contract with the seller, a contract of sale. Now, through this contract of sale, both the seller and myself have agreed that he is bound to sell that particular piece of land to me along with all the rights that he has on that particular immovable property. Sorry, I'll rephrase myself. The immovable property as well as the rights in that immovable property must be transferred to me. Okay, so this is the contract of sale that we both have entered into. Now, in the event that he fails to do so, I have, by virtue of this contract of sale agreement, the right to claim damages, to claim compensation. So the question arises that in the case where this particular right to obtain conveyance of that particular immovable property is held by me, can this right be then considered to be a capital asset? And in the event that I decide to give up this right and receive consideration for the same, will that result into capital gains? For that, I invite your attention to a case law called CIT versus Tata Services Limited. And the facts of this case are as follows. Tata Services Limited initially entered into a contract with the seller for acquisition of a particular land. But the seller was reluctant in providing the conveyance of the land to Tata Services Limited. And due to this, Tata Services Limited decided to go ahead and sign a tripartite agreement between Tata Services, the seller, and the third party. So what happened in this agreement, or the terms of this agreement, was that Tata Services would give away this right to obtain conveyance to this third party, of course, in return for compensation or consideration. Now the question arose, should capital gains arise in this case scenario? The Bombay High Court in this particular decision noted that the contract which was signed for sale of land was capable of demanding a specific performance, was capable of demanding, it had a right to demand conveyance. And this particular right was transferable, was assignable. That is why Tata Services Limited transferred this right to the third party. So because of this, the High Court said that this is a right which is satisfying the requirements, the features of the term property as defined under section 2 clause 14. Therefore, a right to obtain conveyance will also be a capital asset. And in the event this right is given up for a consideration, such consideration will be taxable as capital gains. Now, here are some additional decisions for your reference where similar judicial decision was passed. So just to summarize, right to obtain conveyance is a right because it is a property, it satisfies the features of property. Therefore, it is a capital asset as contemplated under section 2 clause 14. And where this right is given up for consideration, it will result in capital gains. We move ahead. The next interesting point of discussion is leasehold rights or tenancy rights. So again, now leasehold rights or tenancy rights, they are the rights which arise out of immovable property. In the case A.R. Krishnamurthy and another versus CIT, the matter was before the Supreme Court, and here it was decided, it was held that transfer of a mining license was considered to be a transfer of a capital asset. So transfer of a mining lease, sorry, it isn't license, I'll rephrase myself. Transfer of mining lease was considered to be a transfer of a capital asset. Now, again, the initial discussion which we had with respect to development rights, the same points would often come up, that because this is a right which is arising out of immovable property and where I cannot purchase it, I cannot ascertain the cost of it. And if I cannot ascertain the cost of it, I cannot ascertain the capital gain, so on and so forth. And for that, if you remember, while I was showing you the slide on 55(2)(a), I highlighted the term tenancy right. So tenancy right is expressly provided in 55(2)(a), and there it says, well, you haven't purchased it, then in that case, it will be, the cost of acquisition of such right will be considered to be nil. Now we've had an exhaustive discussion on capital asset. So let's move on to the second condition for chargeability of capital gains, which is transfer. So the term transfer is defined under Section 2, Clause 47. And there are several transactions that has been mentioned here. Okay, so sale, exchange, relinquishment, extinguishment, compulsory acquisition, etc., etc. There are plenty of transactions mentioned here. But of course, capital gains tax in itself is a very vast topic to cover, and I have extremely shortage of time right now. So I'm going to restrict our discussion with respect to 3 items. A, relinquishment of asset, B, extinguishment of right, and C, compulsory acquisition. Now, what do you mean, or rather, what is the difference between a relinquishment of asset and an extinguishment of right? In the case of relinquishment of asset, the right over that particular asset is given up. However, the asset continues to exist. The asset is in existence. But the same is not true with respect to extinguishment of right. In the case of extinguishment of right, the right itself ceases to exist. The right itself is gone. It does not exist anymore. And lastly, the third term is compulsory acquisition. Now let us take it up one by one. The first point that we want to discuss is extinguishment of rights and assets. And for this, I take you to Section 45, Clause 1A of the Income Tax Act. Here it says, in the event that a capital asset is either damaged or it is destroyed owing to the reasons mentioned in this section, which could be flood, typhoon, riot, civil disturbance, etc., etc. If the asset is damaged or destroyed, then the compensation received for it from the insurer, and this compensation either could be a cash compensation or another capital asset, that is compensation or consideration in kind. Either of it could be received. So the amount that is so received and any profit or gain arising therefrom will be subjected to capital gains tax. Because A, the capital asset which was destroyed, first of all, the first condition, there is a capital asset involved. B, the capital asset is destroyed, so there is an extinguishment of right. So it is a transfer as per Section 2, Clause 47. And therefore, capital gains arises. But here, the distinct feature is, if you remember, the third condition that we had referred while we were discussing Section 45, Section 45, subsection 1, was that transfer should take place in the previous year. But here, taxability arises not in the year when the property was damaged or destroyed, but rather in the year when the compensation for the same was received. So, under 45, Clause 1A, the period in which the transfer actually takes place and the year in which taxability actually arises are two distinct periods. So there are certainly some exceptions. We move ahead. Compulsory acquisition. Again, what do you mean by compulsory acquisition? Well, simply it means that the land is compulsorily acquired on account of a particular act, on account of particular regulations by a competent authority. And these acts could be, I've listed some acts for your reference, such as Land Acquisition Act, for instance. And the consideration that is receivable at the time of compulsory acquisition is determined or is approved either by the central government or by the Reserve Bank of India. Now, again, in the case of compulsory acquisition, we have to refer section 45, subsection 5. In this particular section, it says that at the time compulsory acquisition occurs, the taxation will arise not in the year in which such compulsory acquisition has occurred, but in the year in which compensation is received. So initial compensation or subsequent compensation, the year in which such compensation is received, in that particular year, taxability will arise. So again, just like what we saw a while back in 45 clause 1A, similar thing is happening here. Capital asset exists. This capital asset is being compulsorily acquired. Compulsory acquisition is very well within the definition of section 2 clause 47. And in this case scenario, the year in which the transfer is taking place and the year in which the taxability arises are two distinct periods. We move ahead. The next topic that I want to discuss is reverse mortgage. So what is this? A pretty interesting one. So Finance Act 2008, it introduced the concept of reverse mortgage, and this is for the benefit of senior citizens, that is persons above the age of 60 years. So what happens basically in reverse mortgages? A senior citizen who owns a particular property, who owns a house, he approaches the bank and he mortgages this house. Upon such mortgage, either the bank pays him a lump sum amount or a monthly stream of income. But a very interesting aspect of this particular reverse mortgage scheme is that the senior citizen who has mortgaged this property, he can, throughout his lifespan, that is until his death, he does not have to either repay the loan or service the loan. That is, he doesn't have to pay any interest on it. He doesn't have to make any principal repayment. But it is extremely important that the terms of this mortgage are in line with the reverse mortgage scheme as notified wide notification dated 30th September 2008. So the question arises, A, how does the bank recover its money? Well, bank gives an option that if you want to discharge this particular mortgage, if you want to, you can do so by repaying the entire amount which the bank has lent. Okay, so once the payment is made, again, the mortgage comes to an end. But in the event such mortgage does not come to an end, then in that case scenario, upon the death of that particular citizen, upon the death of the owner of the house, this particular mortgage or this particular property will be auctioned off by the bank, and the proceeds received therefrom will be utilized in order to recover the amount of debt that was lent. So the first question arises, then is reverse mortgage a transfer? Because there is a right, this right is being transferred to the bank by the house owner, and the bank, upon the demise of the house owner, has the ability to auction off the particular property. So there is a right and there is a transfer of right, apparently. So is it a transfer? For that, we don't need to scratch our heads. We simply have to refer section 47, clause 16. So section 47 basically deals with the transactions which may seem as a transfer, but are not regarded as a transfer. The act itself says that these set of transactions are not transfer. And one such transaction is reverse mortgage. So by 47, clause 16, the transaction of reverse mortgage is not considered to be a transfer. Achha, this one point gets covered now. Fine, this is not a transfer. But the bank was paying a monthly stream of income to the senior citizen. What about that? Shouldn't that income be taxed? Shouldn't that income be taxed in the hands of the senior citizen? Well, for this, again, we have section 10, clause 43, which says that income received either in lump sum or as a monthly stream of income from the bank by the senior citizen will be exempt from income tax. So that is the entire reverse mortgage scheme. Next, we move on to another important, interesting topic, family settlement. So what do you understand by the term family settlement? Well, we are aware that families tend to have disputes, and sometimes these disputes could be with regards to the property, with regards to the assets of the family, and where these disputes are heated up, they even reach to the court, and the court orders a decree whereby an arrangement is made an arrangement is made for amicable settlement. Now, at the time of execution of this decree, it might often be the case that property owned by one particular person or the right of a particular member of the family is transferred from one family member to the other family member, or the entire property which is originally held by the family is divided amongst various family members. So there is a capital asset and there is transfer occurring. So is it a transfer or is it not a transfer? Again, section 47 comes to our rescue. Under section 47, clearly there are several transactions. One such transaction is any distribution of capital asset, either on total partition or on partial partition of a HUF, the assets which are distributed, that will not be considered as a transfer for the purposes of section 45. Additionally, any transfer which is made, any transfer of capital asset which is made under a gift, under a will, or an irrevocable trust will also not be regarded as a transfer. There are certain judicial precedents. We are running short of time, so I'll just skip it and I'll move ahead. The next term that I want to discuss with you is slum sale. So what is slum sale? First of all, the provisions pertaining to slum sale have been defined under section 50B of the Income Tax Act. So before we move on to the specific provisions and the specific conditions, I understand it's 6 p.m. So is it okay if I extend for another 10 minutes or should I stop? Hello?
I think it is okay. You can continue for 2 hours.
Okay, so I'll continue for another 10 minutes. I hope that's fine.
Yes,
Yeah.
yes.
Okay,
Absolutely.
thank you. So I'll come back to slum sale. Well, before we enter into the nitty-gritties, what is a slum sale? In very simple layman terms, slum sale means that an undertaking is sold off for a consideration without assigning individual value to the assets and the liabilities. So each of the assets, each of the liabilities are not given individual value. Entirely, the undertaking is sold for a lump sum consideration. This is nothing but slum sale, and it is covered under section 50B of the Income Tax Act. Now, let us go to section 2, clause 42C, which defines the term slum sale. Now, there has been an amendment in the definition of slum sale through Finance Act 2021. Yeah, I'm sorry. I think I'm running out of. Yes. Is this visible to you?
Yes, it is visible.
Yeah. So pre-amendment of Finance Act 2021, the term slum sale meant transfer, okay, for a lump sum consideration. However, oftentimes before the court, this was contested, saying that, well, what happens if a slum sale is made, but no cash consideration is received? Instead, consideration is kind and received. Then will it qualify to be a slum sale? And several decisions said, no, it will not be considered as a slum sale. Instead, this is a transaction of exchange. However, the Section 2, Clause 42C has been revised, has been amended through Finance Act 2021. And in this, it says that slum sale means the transfer of one or more undertakings by any means. So the relevance, the importance of the term by any means is extremely significant here. I'm sorry, I'm experiencing some technical issues at my end.
No problem.
Yeah, okay, we are back.
Yeah.
So post amendment, the words that are highlighted or that are in bold is transfer of one or more undertakings by any means. So what is the meaning of this? What is the relevance of this term, this phrase by any means? Well, now it brings within its ambit all the modes of transfer which were mentioned under section 2 clause 47. So even if an undertaking is sold not for cash but for kind, then even that will be considered as a slump sale. This is very important amendment which has come. Now again here there is a case law called CIT versus Bharat Bijli, Bombay High Court decision. Here the matter was, well, slump sale occurred, but in return shares were received and not cash. So then the court, it held that, well, this is not a slump sale because you're not receiving cash consideration. Instead, this is a transaction of exchange. But by the virtue of this change in the definition, I hope you understand that all these judgments, all these rulings stand nullified. And the other important thing that I wish to highlight is, although this was inserted through Finance Act 21, it has a retrospective impact. It is retrospectively effective from 1st April 2020. Not just the meaning of slump sale, but also the manner of computation of slump sale has undergone a change. There is an amendment even with regards to this. So earlier, the computation of capital gain in the case of a slump sale was done in this manner. The consideration received in full was taken, expenses incurred for the transfer were reduced, and finally, the net worth was considered to be the cost of acquisition, and the resultant capital gain or loss was subjected to taxation. Now here, would the resultant capital gain or loss be a short-term capital gain or a long-term capital gain, or a short-term capital loss or a long-term capital loss, depended upon the factor that whether the undertaking was held for a period of 36 months or more, or less than 36 months. So in the case where it was held for 36 months or more, it was considered to be long-term. And where it was held for a period of less than 36 months, it was considered to be short-term. This is the manner in which the net worth was computed. I am going ahead considering the shortage of time. And now the one important thing that I wanted to highlight was, post-amendment, the term fair market value is introduced in the slump sale. So it says that now the fair market value, I'll just take you to the previous slide. If you just pay your kind attention to 50B subsection 2 clause 2, it says fair market value of the capital asset as on the date of the transfer, calculated in the prescribed manner, shall be deemed to be the value of consideration. So the fair market value now would be taken as FVOC, or the full value of consideration. Now the words prescribed in the manner. So it is prescribed in Rule 11 UAE of the income tax rules, whereby it says that the fair market, the FVOC will be higher of the two terms. Either it would be the book value of the assets less the book value of liabilities, or 2, it will be nothing but the consideration which is received or accruing. So whichever is higher will be taken as a full value of consideration. Now, I hope you realize that by doing so, the concept of gains or losses is no longer relevant here, because the term because of the introduction of the term fair market value, and the entire amount then will be subjected to taxation. These are certain judicial precedents pertaining to slump sale. And The alternative to slum sale would be itemized sale, that is assigning value to each of the assets before their sale, right? So what are the impact or what are the differences? Well, in the case of a depreciable asset, when depreciable asset is sold, since we are selling the block of asset, it will always be treated as a short-term capital gain or a short-term capital loss, right? So let us consider it results into a short-term capital gain, and it will be taxed at the rate applicable to the company. However, if the same asset is sold as a slump sale, and if it is held for more than 3 years, it will be treated as a long-term capital gain, and it will be subjected to a reduced taxation of 20%. Lastly, we move to Section 50C. Section 50C simply says that at the time of sale of either land or building or both, the consideration received must be not less than the stamp duty value. However, a tolerance band, that is a variation of 10%, is allowed. Now, earlier, before 1st April 2021, this was not 10%, but instead 5%. Now, this tolerance band has been increased to 10%. And the first point that we had earlier discussed, which was leasehold rights. So then the question arises that, well, leasehold rights, they are also a right which is attached to immovable property, right? So since Section 50C is applicable to land and building, would it also be applicable to leasehold rights? The answer is no, and courtesy of certain decisions that I have mentioned here for your reference. With that, thank you so much for patient listening, and I hope the session was informative. In case you wish to reach out to me, I have provided my email ID and my mobile number. Thank you so much for giving me the opportunity to appear here as a speaker. Even though being a young member, this is a brilliant opportunity. With that, thank you so much.
Yeah.
Archana, yeah, we have a couple of questions from the participants. The first question is, usually old jewelry is given to the jewelry shop and a new one obtained by paying extra cost. Is any liability to capital gains arises in such a case? Hello, Archana? Archana, your video is paused.
Maybe someone can from the office, someone can call her to rejoin.
Hello. Yeah,
Yes.
I am so sorry. I'm experiencing some terrible technical issues. I don't know why. If it
No
doesn't
problem.
cause any inconvenience, may I please hear the question again?
Hey, you are on mute.
Yeah. So usually old jewelry is given to the jewelry shop and a new one is obtained by paying extra cost. Is any liability to capital gains arises in such a case?
So, firstly, let us try and understand this from the perspective of the charging section. First of all, there is the jewelry that you've just mentioned. It is a capital asset. It falls within the definition of capital asset. We've already seen that, right? So, personal effects involving jewelry is a capital asset. Secondly, the second point which you said was this jewelry is exchanged. Am I correct?
Yeah, exchange
Yeah.
for a new one, and the
Okay.
differential amount is paid to the
So
jeweler.
I'll just stop you for a while. So the exchange is considered to be a transfer as per section 2 clause 47. So there is a capital asset, there is a transfer which has taken place. So certainly capital gains will arise. Okay, on the differential amount.
So the next question is, X has acquired a residential house in exchange of agricultural land in a rural area. What is his COA in this case?
We'll have to look, we'll have to refer to the provisions pertaining to agricultural land for that. You'll have to refer that.
So those were the two questions which we had from the participants. Moving on to a vote of thanks. So it is a privilege and a pleasure to extend a heartfelt gratitude to our today's speaker, C. Archana Kshatriya, for his insightful speech on capital gains taxation. Madam, you have covered the topic in depth, starting right from the history of capital gains taxation, the charging section, relinquishment of assets, and slum sale, and a lot of other topics. Your explanations were clear and your examples were practical, making it easier, for us to grasp and understand. Really appreciate your approach on converting the concepts into a story, because it is easier to remember a story compared to a concept. So we are really excited to put this new acquired knowledge into practice, and hope everyone hope to see that everyone is applying this in their day-to-day lives. And once again, thank you for your time and dedication to put this entire presentation and speech for our members over here. And we look forward for future opportunities to learn from you. And thank you.
Thank you so much. Thank you. Thanks a lot.